It's Mike. It's hard to believe that we're at the end of July now, right? So today's title is "The Fed Won't Save the Housing Market." Everybody seems to think that this week's Fed meeting is going to magically shift mortgage rates, and I don't think that's how this plays out, right? Let's talk about it. So the Fed meeting everybody's watching. Fed meets this week, and most economists expect no change to the federal funds rate. In fact, there's an article with Barron saying the bond route is bruising would-be homebuyers and challenging the Fed. So, really, the Federal Reserve in this article saying that it's really zipped its lip for the path for future interest rate moves, whether up or down. And it's because we're in what they're calling an unexpectedly resilient U.S. economy. Of course, we have to acknowledge what's going on with Iran. It's really driven a sell-off in the world's largest mortgage bond market and mortgage-backed securities. We're seeing that in bonds as a whole. That's what Barron's had produced today in their article. And it's interesting because what the article goes on to, and many others, is talking about the real story isn't in the announcement. It's the comments afterward from a Fed chair. But what we need to remember, and I've done several articles on this, I've actually wrote a book on the Federal Reserve. Please check it out called Fed Made Simple. It's on Amazon. Link will be below this. But the Federal Reserve doesn't control mortgage rates, right? They influence them in some ways, but the bond market's really what makes the final call. So if you look at 10-year Treasury right now, I'm going to look at, see here, looking at what bonds are doing. And I'll share my screen with you here to see what this looks like. But if we look at mortgage-backed securities today, really what we're looking at with markets, let's take a look at that. So just a moment here. I'll share my screen so you can take a look at some of the things that we're seeing. And so we have markets overview, right? 10-year. Let's get this one real quick. I apologize. This loads a little slow, but there we go. So if we're looking at these charts, now look at this. Okay. We could go back to March. Really, March is where things got really crazy. We saw April, late April, saw here in May, right? We go through May, a lot of really bad days for the bond market, mortgage rates. And a lot of that was, of course, what's going on internationally with global conflict, things of that sort, especially with Iran, oil, what have you. And get into June. Now we're stepping into July. Really harsh days, couple of in July. You can see these lock screens. This is from NBS Highway, but they have lock screens when they give you a lock alert. And so really, I mean, if you look at most commentaries, what we're saying, if you get something in escrow right now, go ahead, lock it. Just lock it. Don't play the game. Don't gamble, right? Some people are saying carefully float right now. In my opinion, lock. Things will calm down. I do think eventually things will get better. But for right now, we're in some bad territory. Now, we did have a couple of good days here. And I think it's because of people waiting what the Fed says, right? That's where we are right now, the 28th. So we're getting some good news. Look at this 10-year Treasury. We're up to 4.65. Now it's coming down to 4.59. Pretty good. 19 basis points on mortgage-backed securities. In case you're wondering, that's a pretty good swing for rates. You can see like an eighth of a percent of an improvement. We want to see better improvements, all right? Let's be honest. We want to see rates come back. You know, we're seeing at 6.5, 6.75 on average on a 30-year note for conventional mortgage. We really want to see those back 5.5 to 6%, 2.5 to 3%. I'll be honest, I don't think it's going to happen in our lifetime. But if it does, great, right? I mean, no one has a crystal ball. But keep in mind, as I mentioned, the Fed doesn't control mortgage rates, influence them, but the bond market makes the final call. Well, what are things that affect rates? Let's go through that real quick. We're looking at why rates are so high, right? The 10-year Treasury, as I just showed, elevated. Oil and geopolitical tensions continuing to impact inflation. Now, inflation's that second point. Inflation is the arch enemy for mortgage rates, right? It's kind of like the nemesis. If you saw Masters of the Universe, I have a newborn, so my wife and I are watching like 30 to 40 minutes at a time right now, and then we have to go to bed because of the baby. But you know, it's funny because, you know, Skeletor, I hate to bring it up, but I'm 46. I grew up in the 80s. He-Man was my hero when I was in preschool. But anyways, yeah, it's kind of like Skeletor, right? Like these crazy things. I can't believe I just compared inflation to Skeletor. But anyhow, that said, let's think about what's going on in the market now. Well, if inflation gears its ugly head towards the bond market's going to turn around and you're going to see those swings, you're going to see those margins increase, you're going to see rates go up as a result. So we have that. We have ADP and job numbers. We do have some unemployment, right? When we see the BLS jobs report at the start of every month, but it's not as bad as it could be, which is a good thing. But jobs numbers will affect the economy as well. Inflation reports, you're looking at personal consumption expenditure. People are still spending money out there. Um, Goods still cost more because of inflation, but they still have to buy groceries, gas, right? There's summer. I mean, these things are still happening. So really, these things are those items that affect mortgage rates. And again, I have articles written on this. Feel free to visit my blog. I write on this weekly. Every Friday it comes out, kind of a recap of what we saw in last week, what we're projecting for the following week. So mortgage rates recently touched their highest levels, though, nearly a year. Now they're recovering a little bit, right? As I just showed. So people keep asking why rates aren't falling. The answer is the bond market isn't convinced inflation is behind us, right? So it's going to be very interesting to see what the Fed says. Now, and that's what I'm saying, the commentary means so much more than an increase or decrease in rate. So one thing, the housing market is adapting. New home sales bounced modestly in June. We did see home prices improve a little bit. Builders are adjusting with incentives instead of waiting. So we're seeing new homes being sold. Lower priced homes are moving better than luxury inventory. A lot of first-time home buyers, in fact, we closed 4 VA transactions last month. We closed 3 first-time homebuyers using down payment assistance, and we had a couple of other first-time homebuyers as well. So we had a good month, really. And all things, people are still buying houses. Inventories improved while affordability still remains the biggest challenge. Reuters produced an article on that. It's interesting because the Reuters article kind of went into detail on that. I feel like they could have done a little bit better, but it does really show what we know, right? We see no home sales rising 1.6. That's a small, modest increase. Median home price fell 2.7. So home prices are down a little bit. This is nationwide average. And of course, with the mortgage rate around 6.5 to 6.625, we're seeing, of course, mortgage rates on the rise, right? And we go back to March. There's a huge spike in this article. I like it because it does talk about the spike that we saw from first quarter going into second. And of course, steep borrowing costs, right? It's causing a lot of issues for folks. So it's a pretty good article I think readers put out today in regards to that. So something to really be mindful of, but keep in mind the market's not broken, it's adapting. And even though afforded or inventories improved a little bit, there's still not a lot of inventory out there. I'm still seeing multiple offers, right? So keep in mind it's adapting. We're still in a market. So what we're seeing more negotiations. We're seeing seller credits. We're seeing buy downs from the seller. Seeing a lot of self-employed borrowers coming out, bank statement loans, profit and loss loans. We're seeing investors actually purchase investment properties. We're seeing a lot of TIC transactions for markets like Los Angeles, San Diego, San Francisco. We're seeing a lot of first-time homebuyers get their offers accepted, right? We closed a jumbo transaction that was a multiple offer situation in Oakland, California in 7 days, start to finish. So that buyer bought 20% down. Strong buyer. They finally got the home that they wanted in Oakland Hills. That was such a win. And then we had a couple of VA buyers, as I mentioned just a moment ago. VA buyers closing in as little as 10 days. They're standing out. VA offers, if you're an agent out there and you're listening to this even, look at VA offers. If you want to talk to me about VA home loans, let's get a call. I have presentations. There's a masterclass I've recorded on this YouTube channel. Check it out, right? So here's a hot take. Stop waiting for perfect rates. If you're waiting for the Fed to make buying a house easy again, you're waiting a long time. The Fed doesn't decide rates. Mortgage bonds do. Mortgage-backed securities, 10-year treasury. Watch that instead. When rates are 2-3%, the 10-year T-bill, 10-year treasury bill, go look it up. I can show in charts if you'd like to give me back to the screen, or jump on a call, schedule a call with me, we'll go over it. 0.5%, or less than 1% on the 10-year treasury. But so if you're waiting to, again, for the Fed to make buying a house easy again, you could be waiting a long time. So think about marriage. If you're getting married, if you want to own a home together, develop equity for your family. Kids, right? For growing your family. Job changes, growing families, investing. life doesn't pause because rates are 6.5 to 6.75%, right? We saw that. We saw people buying when they're 7.25, 7.5. Competitive, 12 to 14 day closes. So the Fed will make headlines this week, but the bigger story is still the bond market. That's what's driving mortgage rates, and that's what I'll be watching. And if you go to my blog on Friday or want to have the email sent to you, shoot me a message, visit the link in the bio, connect with me. Happy to share that information with you. But thank you for watching this. And yeah, always around. Have a great week.